Michael Burry was made famous from The Big Short, a massive bet that virtually nobody in the industry agreed with. Nobody would acknowledge. Nobody understood what Burry did, and in hindsight, many pretend that it was so obvious. But the truth is that it wasn't, because it's convoluted and confusing intentionally. In 2007, the Fed refused to acknowledge that there were issues. They continued to pretend that this wasn't a deeply rooted problem back in 2008, and in 2009 and 2010, they simply kept saying that everything was just fine, right through an entire cycle. Such injustice and a disservice to the people shouldn't be tolerated, and yet it's happening again. You came here for the truth, so let me unveil that for you. Today we are going to have our focus on hyperinflation. I think this is really important, not just because we're talking about Michael Burry and what he had highlighted the previous instance, but certainly it is worth looking at. I'm going to show you some other factors as well. I think it is very clear, as I have documented over 10 years on this channel now, and we could see the same mistakes being made throughout every cycle. I have been highlighting history over and over and over again, and I just want to show you right now what Michael Burry had to say and then connect that in with a few other issues. He went on a tweet storm, tweet after tweet, and he was breaking it all down, having some quotes, some charts. I want to give you everything that you need to know. But first, I wanted to just suggest to you that just because Michael Burry said it, it doesn't mean it's fact. Just because he said it and believes that this is going to be the case, that it will actually come to be. But we should take it in. What he had said back in 2007 was clearly like a crystal ball. If you look at it back, let's say in 2009, looking backwards, and he was doing that at a time when it was very, very unpopular. Everyone was telling him that there was nothing to worry about for all the different reasons. I'm sure that you either read the book or watched the movie The Big Short. You knew what happened. But it's a very difficult thing to do when you're going against the grain. So I wanted to just mention that. Let's get into it. He made this tweet right here, and I think that it needs to be said right away. People say that I didn't warn last time. I did, but no one listened. So I warned this time, and still no one listens. But I will have proof I warned. And that's what I wanted to lead with today. And of course, I'll show you what he means exactly in just a second. But it isn't very, let's say, a regular event when you see these economists that actually put this type of thing in black and white. They're usually kind of sidestepping and whitewashing and being very vague on purpose because it's impossible to be able to determine the future. But for someone like Burry, he wants to make it known that there is some seriously unfortunate events that are coming this way. Any country who has been engaging in all of these different hyperinflationary policies, whether that's coming from the government and the stimulus packages, or whether that's coming from the quantitative easing of the central banks, are going to have to pay the price. You cannot get away with it. History is showing us that eventually that comes to bite you in the behind, and this is just what he is highlighting in this case. All right, part of the several tweets that he put out was this chart here, FINRA, margin debt, and the S&P 500. And you can see the blue line, that's the S&P. Margin debt, of course, continues to expand as time goes on. We need to be aware of that because it highlights what they've been doing. More and more debt on every level, more and more margin, more and more leverage. All of these things add up, and we see that until the point where the bubble peaks out, and then suddenly everybody freaks out. Speculative stock bubbles ultimately see the gamblers take on too much debt. Margin debt popularity accelerates at peaks. At this point, in the market is dancing on a knife's edge. Passive investing's IQ drain and the stonks group hype add to the danger. We've seen the retail traders and what has happened here. He's simply acknowledging that and essentially looking at the passive investing, these ETFs, and the danger that that causes as well. If people don't believe that ETFs are dangerous, just like anything else, they believe that they're well diversified, they believe that they're safe and sound, but understand that we don't even have history on ETFs because the last real market cycle, when you look at what happened during 2007 through 2009, ETFs were a fraction of the size that they are today. Even Jack Bogle himself said that ETFs, while they're great and they sort of level the playing field, this is an issue when it comes time to sell. So that's something I wanted to point out here. This is a chart I have shown you many times before, but he's also highlighting it, and that's the CBOE put-call ratio is breaking to new bull market lows in the last 6 months as that massive spike in call option volume outstrips the hedges. And this is, of course, just showing you another way of looking at how much risk-taking is taking place in the markets today. Everybody is putting all their chips in, and you know that. You can see the cash balances that are dwindling. Why? Because all the money is moving into equities. We see that very clearly. You could look at what the amount of negative yielding debt out there. There are, the last time I checked, it was something like 16 or 15 trillion dollars worth of negative yielding debt. Why would anybody want that? Why would an investor want that when they can simply get into equities that are continuing to grow and grow and grow? And yes, there are new technologies coming. Yes, there's a lot of promise for the future, but we need to understand when there is too much euphoria and optimism, things turn around on a dime. It happens a lot faster than anybody would be prepared for. Check this one out. Note that FINRA margin debt data understates the leverage in equities. Together with margin debt in stocks, there is leverage through call options. Note that the CBOE weekly call options volume has been making new highs for over a year now. Good to know why stonks go up. Right? He's making a very clear point, and I think it's important to see what had happened from 2020 into 2021. It's basically been a straight line upward, and that should tell you something, because people have never taken this much risk. We've seen all of the different scenarios before. We've seen all the cycles. We've broken it down here on the channel, but of course, I know you've read into it yourself, but we've never seen anything like this today. And that's so extreme, and yet you can't really see it when you're on the inside. But after we look in the pages of history, it's going to seem a lot more obvious. The US government is inviting inflation with its MMT-tinged policies, brisk debt over GDP, M2 increases while retail sales and PMI stage a V-shaped recovery, trillions more stimulus and reopening to boost demand as employee and supply chain costs skyrocket. This is important, okay? So then he quotes this document here, which I'm going to show you the quotes that he pulled out from there, but if you're interested, you can definitely read it. Essentially what he's saying that if we go into this reopening, there's pent up demand, there's a lot of investment that's going to take place, and people are going to start buying things that they weren't doing before for all of 2020 into 2021. So that, of course, is coming at a time when they are pushing out all these different stimulus packages when they perhaps shouldn't be doing that. And you look at all the quantitative easing, and you look at all the different processes and policies and everything that they've been putting in place and trying, really trying to send the helicopter money from the skies. So this is going to have some reverberations, and it will sustain for a period. And they show you this relating back to Weimar Germany. And that is a time in which everybody knows they saw the wheelbarrows and they saw the people using the marks as basically, put them in the fireplace and so on to heat up the homes. This is something that might be difficult to see the parallels till today, but it happens rapidly. And that's the whole point. I'll show you just a couple points from it. But if you want to read them all, I suggest going to Burry's Twitter. But just take a look at this and understand that it happens faster than anyone is willing to imagine. The life of the inflation in its ripening stage was a paradox which had its own unmistakable characteristics. One was the great wealth, at least of those favored by the boom. Many great fortunes sprang up overnight. The cities had an aimless and wanton youth. You go down further and it just shows you other things. Prices in Germany were steady and both businesses and the stock market were booming. The exchange rate of the mark against the dollar and other currencies actually rose for a time, and the mark was momentarily the strongest currency in the world on inflation's eve. Side by side with the wealth were pockets of poverty. Greater numbers of people remained on the outside of the easy money, looking in, but not able to enter. The crime rate soared. And by the way, you could see a lot of parallels, but not necessarily it's going to ever end up exactly the same. But certainly we could learn from this, all right? I know I don't want to read it all to you, but I think it's important to just understand that there are these parallels, that there are the same mistakes that are repeated over and over again. I did talk about it in my first book a lot, but I know that if you've been on this channel, you know exactly what's going on. Central bank policies, government policies are put in place, and they do create, let's say, the haves and the have-nots. They create the divide in between those who have the money and those who do not, and all of the things that they put in place to fix that is simply only, it's exacerbating the initial conditions. This comes out of Bank of America, and you could see that at the end of WW1 caused jump in German money velocity and inflation. And that's really the worry here. If you look at what's been happening with all of these different policies that have been put in place, the monetary velocity had simply dropped. And you don't get heavy inflation in their statistics anyway, not real inflation, which I'll show you in just a second. But you don't get that until the money velocity picks back up. So that is the concern. And you could see right here, it's hard to see on the chart, but velocity year-over-year percentage, 1914 to 1923. In 1918, as you can see here, it's minus 34. But in 1919, it's 129. Inflation goes from 21 to 228 in 1 year. So you could see how fast these things happen. People can't prepare for that. They can't say, well, okay, when there's a bad thing coming, then I'm going to get ready. Then I'm going to be prepared. It doesn't work like that. It never has, and of course, never will. This article out of the Wall Street Journal is entitled, "Companies Aren't Saving Their Pennies as Markets Turn Bubbly." And you see this every time in any bubble because they are unwilling to actually save for a rainy day, right? When money is readily available and almost free, why bother saving for a rainy day? And that's what many, not just companies, but people feel. That's their mentality right now. I need to achieve that capital appreciation at the highest level, so I'm willing to use a 3x leveraged ETF. I'm willing to go all out. I'm willing to use margin. I'm willing to get into debt because the Federal Reserve will be there to ensure that this continues. We have seen this time and time again how that is in fact a very, very dangerous policy. For corporations, the question is worth asking at a time when dollars might as well be falling from the sky. The average rate on the so-called high yield bonds recently fell below 4% to a record low. In the late 1990s, even corporate borrowers with the best reputations paid average interest rates on the order of 7%. There is so much money looking for a place to go that companies are being contacted by investors asking if they would like to issue bonds rated below investment grade rather than the other way around. This is a wacky market that we're seeing today, and there's no doubt going to be so many books written about this time. It will be exciting. There's no doubt about that, but it is a concern because of the risk factor and how it's kind of pushing everybody because of these low interest rates. It's pushing everybody into that zone of maximum risk taking. I showed you this in a previous video, maybe 2 days ago or something, but I wanted to be very clear about what's happening because I think it's really, really integral to understand that people never, ever, ever prepare in advance, and you can see what goes on as a result of all of that. Bubble warnings go unheeded as everyone is a buyer in stocks. S&P 500 rally is the fastest this far into the cycle in 9 decades. Investors double down on stocks while corporate buybacks jump. They're loving it. They're going just completely headfirst into this. And while that's fantastic on the way up, it really, really hurts on the way down. Canadians take on mortgage debt at the fastest pace in a decade. Same situation here. You are seeing people that are taking on this debt. They believe that as long as interest rates remain low, you're all good. But of course, this cannot last forever. Everything must come to an end. Now, there could be a problem in which you encounter, not for Canada necessarily, but any country, where you encounter this hyperinflationary spiral, and that creates a devastating effect on basically everything. If you go to any of these developing nations and see how they deal with heavy rates of inflation, you know it's a mess. It's not so orderly where you think, well, okay, I'll just buy these stocks and it's going to go up in a straight line because that's hyperinflation. It doesn't work like that at all. We need to look at this more in depth. You've got analysts like this. I mean, they're being quoted in Bloomberg telling you how everything is absolutely fantastic. They're going to just keep pushing out these stimulus packages. You've got nothing to worry about in terms of inflation. The Federal Reserve is going to control it. They've got this under control. They always have. They're fantastic. It's amazing, and so on. This is what the type of information that they get. Like I said, 2007, 2008, 2009, 2010, right through the entire cycle. And meanwhile, millions were impoverished during that process, and nobody wants to acknowledge that. It was all because of the policies put in place by these people, and yet they're looking at them as a savior. It's a big mistake. That brings me to this. Out of the Wall Street Journal, they actually had some truth to share, and I wanted to bring it to you as quickly as I could here, because if you look at what the Federal Reserve uses for their measurement of inflation, you're never going to find inflation, okay? So it's a simple matter of fact. But here, the Federal Reserve predicates its easy money policies in part on the fact that its favorite measure of inflation has run more than 0.5 percentage point below its goal for several years. So of course, they look at the core PCE rate. It's at 1.5%. That means if they want to get to 2% and actually beyond 2%, they've got a lot of room to go. You don't need to worry about printing money and all that because, hey, no worries, we're at 1.5% inflation. But what they argue here in this article is that if you're using a flawed measure, obviously you're not going to be able to see the inflation. With inflation so low for so long, the thinking goes the Fed can hold interest rates very low for a while to help boost the economy. This raises an important question. Is the central bank thinking about inflation properly? The Fed defines its inflation target in terms of consumer prices, such as those we pay for cars, toothpaste, haircuts. But in recent decades, prices have often climbed much faster for investment assets such as homes and stocks, and twice led to booms and busts followed by recessions. So that's what I always say. If you're acknowledging what's going on with just what's in their core PCE rate, you're not going to see where all the other inflation has been around. I mean, look at healthcare. That's one very good example because people are buying it and the price is absolutely skyrocketing, and that isn't taken into account. If the Fed does run into problems with low interest rates it helped to engineer, it might be because of asset prices and not consumer prices. And they get into the fact that they were supposedly, supposed to get into this stable prices thing, which we know is not true. That they have done the exact opposite of creating stable prices. There's no doubt about it. And then they just go on to talk about the fact that what they're doing is actually destabilizing the system and creating a problem, and that's not going to show up in the official stats. And I just wanted to actually show that to you because mainstream media, once in a while, lets out a bit of truth. Then I wanted to finish with this. I mean, you look at what happened in Texas, you see what happened so many times before where there are different disasters and people in need. People do not prepare for the worst. They simply go on about life. They go on all of their different daily events because preparing isn't something that is needed, because we have all these advancements in developed nations. We've got power, we've got running water, we've got, different social safety nets and everything that's in place. And yet there's always events where millions of people are suddenly unprotected. And that's the point. We can't always be chasing the highest level of appreciation in stocks and bonds or whatever assets we're looking at, investments and all these bets that people are making. It's sometimes important to look at the defense. I think that's really key. I'm going to end the video there. If you found that informative, hit that thumbs up. When you do, you're supporting me simply by clicking one button on your screen. Thank you very much. If you want to learn about e-commerce, you can do that for free at the AmazonGPS.com. If you want to learn about the financial system explained extremely easily in these two books, you can check them out at the link in the description. And if you haven't seen this video already, you definitely want to do. You definitely want to check it out, because I talked about Texas in here and what happened along the way. Definitely click it, and I'll see you there.